The entire global financial system stood on the brink of collapse in 1998. Long-term capital management, LTCM, was a highly secretive hedge fund started in 1994 by John Merriweather, an ex-Salomon Brothers trader, along with a dream team of financial academics, including two Nobel laureates, Robert Merton and Myron Scholes. These brilliant minds believed they had cracked the market's code using complex mathematical models for arbitrage strategies across various global markets. Their genius wager involved exploiting tiny price differences between highly correlated assets, a sophisticated strategy that seemed almost risk-free on paper. They deployed massive amounts of capital from investors, approximately $1.25 billion initially. But their true power came from extreme leverage, borrowing tens of billions, sometimes even 100 times their equity, to amplify tiny profits into huge returns. By 1998, LTCM controlled positions worth over $100 billion, becoming an indispensable counterparty for countless banks, brokerage houses, and financial institutions worldwide. This leverage's fatal flaw became horrifyingly clear when unexpected market events unfolded that their models could not predict. The Asian financial crisis in 1997, and then the Russian default in August 1998, triggered a dramatic flight to quality and unprecedented market volatility. Spreads between various asset classes widened dramatically, and historical correlations broke down completely, turning LTCM's highly leveraged bets catastrophic. They started losing huge sums every single day. In just a few terrifying weeks, they lost $4.6 billion, about 90% of their invested capital. Panic quickly spread through Wall Street as LTCM's counterparties realized the immense exposure they had to the failing firm's web of trades. Its demise threatened a devastating domino effect, potentially bringing down multiple major banks and brokerage houses, leading to a complete freeze in global credit markets. This prospect of systemic financial meltdown prompted an unprecedented intervention by the Federal Reserve Bank of New York. In September 1998, the Fed orchestrated a private sector bailout, persuading 14 major banks to inject $3.65 billion into LTCM, effectively taking over its operations to wind down its positions in an orderly fashion. This swift action saved the global economy from an unknown but potentially devastating crisis, and remains a stark warning about excessive leverage, complex financial instruments, and the over-reliance on models, even those developed by the most brilliant minds. The global financial world teetered on destruction. Long-term capital management, an elite hedge fund formed in 1994 by John Merriweather, a former Salomon Brothers trader, together with two Nobel laureates, Robert Merton and Myron Scholes, believed they had truly cracked the market's secret code. Their brilliant arbitrage strategies utilized incredibly complex mathematical models designed to exploit minute price differences between highly correlated assets across various global markets, appearing virtually risk-free on paper. They initially gathered a substantial $1.25 billion from investors, but leveraged this capital to extreme and unprecedented levels, sometimes borrowing 100 times their initial equity. By 1998, this strategy allowed LTCM to control an astonishing $100 billion in positions, making it a crucial, indispensable counterparty for countless major banks, brokerage houses, and financial institutions worldwide. This vast and aggressive leverage, however, proved to be a critical, fatal flaw when unforeseen global market events struck with brutal impact. The Asian financial crisis, starting in 1997, and the subsequent Russian government default in August 1998 completely shattered their sophisticated models. Market volatility surged to extreme levels, asset spreads widened dramatically, and historical correlations broke down completely. LTCM's highly leveraged bets quickly turned catastrophic, resulting in staggering financial losses. They began losing astronomical sums every single day, shedding $4.6 billion, approximately 90% of their entire invested capital, in a mere few terrifying weeks. Panic spread rapidly throughout Wall Street as financial institutions realized their immense and interconnected exposure to LTCM's failing and unwinding trades. The fund's potential demise threatened a devastating domino effect, risking the collapse of multiple major banks and brokerage houses, leading to a complete and prolonged global credit market freeze. This systemic meltdown prospect prompted an unprecedented and urgent intervention by the Federal Reserve Bank of New York. In September 1998, the Fed masterfully orchestrated a private sector bailout, persuading 14 major banks to collectively inject $3.65 billion into LTCM. This swift and decisive action effectively took over the fund, allowing for an orderly winding down of its massive positions. This critical intervention saved the global economy from an unknown but potentially catastrophic crisis of monumental proportions. It serves as a profound and stark reminder about the immense dangers of excessive leverage, overly complex financial instruments, and an absolute over-reliance on even the most brilliant mathematical models ever developed. $4.6 billion vanished in weeks. A market nightmare unfolded. Long-term capital management, a titan of finance, faced its swift reckoning. The Federal Reserve Bank of New York orchestrated an extraordinary private sector bailout in September 1998 to avert a catastrophic global economic collapse. 14 major banks, including powerhouse institutions like Merrill Lynch and JP Morgan Chase, collectively injected $3.65 billion into the flailing hedge fund. This was not a handout, but a strategic move to take over fund operations, ensuring an orderly unwinding of its gargantuan positions. The consortium of banks formed an oversight committee managing the fund's remaining assets and liabilities. Their objective was to prevent fire sales driving market prices down further, triggering a domino effect across the financial system. This careful process of unwinding complex derivatives and vast portfolios took an extended period, stretching into the early 2000s. Market improvements allowed the consortium to liquidate assets at more favorable prices. The initial 90% loss of LTCM's capital, approximately $4.6 billion, had been a shocking blow, but the intervention prevented a complete wipeout for many counterparties. Amazingly, the 14 banks not only recovered their initial $3.65 billion investment, but also managed to turn a profit on the operation. Estimates suggest they garnered around $1 billion in profit through diligent management and market recovery. The fund's founders, including Nobel laureates Robert Merton and Myron Scholes, saw their reputations severely tarnished, and LTCM effectively ceased to exist as an independent entity. Its traumatic failure prompted a profound reevaluation of risk management practices throughout the financial industry. Regulators and financial institutions alike confronted the immense dangers of excessive leverage, highly complex instruments, and over-reliance on mathematical models. The incident highlighted critical importance of liquidity in financial markets and systemic risks posed by interconnected institutions. It served as a stark reminder that even brilliant minds and sophisticated strategies could be overwhelmed by extreme, unforeseen market events like the Asian financial crisis and the Russian default. The possibility of a widespread credit crunch and prolonged global recession was very real, a genuine threat to financial stability. Timely, coordinated intervention saved the global economy from a crisis of unknown but potentially monumental proportions. Lessons from LTCM's collapse reverberated for years, influencing new regulations and risk assessment. It underscored the crucial need for robust oversight and healthy skepticism towards financial innovation, promising risk-free returns. The entire episode emphasized no financial institution, regardless of perceived genius or size, is truly immune to brutal market forces. The global financial system learned an invaluable lesson about risk humility and the interconnected global finance in 1998.